What you need to know before day one. Setting up an LLC on its own doesn't mean you get to take tax deductions. Don't fall for the TikTok tax hack. If you've seen those Instagram reels or TikTok videos claiming you can just set up an LLC and start writing off your car, your vacation, or your home office, know this, they're wrong, dead wrong, and following that advice could cost you. Here's the truth, the IRS doesn't care if you filed an LLC. You don't get to take business deductions unless two things are true. Number one, you have a real profit motive. That means you're operating to make money, not to play entrepreneur on social media. And number two, your business must have actually started. Until then, those deductions are off limits. Let me break it all down for you so you can start business the right way and stay out of trouble. Hey everyone, my name is Gabe Velez. I'm CPA and partner at Vanity and Velez. We help business owners go from confusion to clarity, especially when it comes to the IRS and what it takes to build a lasting business. Today, I'm going to walk you through everything an entrepreneur needs to know before starting or acquiring a business. We'll talk about what qualifies as startup expenses, how organizational costs are different, and why forming an LLC isn't enough to unlock deductions. If you're just planning on spending but haven't actually started operation, you're not in business yet, and the IRS knows it. Business structures. So here's where most people get tripped up. They get tripped up on understanding the difference between legal structure and tax treatment. A limited liability company or a corporation is something you create under state law. These are legal entities that give you liability protection. But when it comes to taxes, the IRS looks at your federal tax classification, not just your legal form. A sole proprietor, partnership, or S corporation is considered a pass-through entity. That means the business itself doesn't pay income tax. Instead, profits and losses pass through to the owner's personal tax returns. In contrast, a C corporation pays its own tax at the corporate level, and then shareholders pay again on dividends received. So it's a double tax setup. But it can have its advantages depending on your growth path and reinvestment strategy. Now about LLCs. An LLC isn't a tax classification, it's a legal shell. A single member LLC is treated as a sole proprietorship by default. A multi-member LLC is taxed as a partnership unless you elect the S Corp or C Corp treatment. Here's why this matters. Only the taxpayer that enters into and operates a trade or business can claim deductions for startup and organizational costs. So you need to understand how your business is organized and how it's taxed. That's how you avoid costly mistakes. Important considerations when choosing a structure. Before you choose a business structure, there are some important questions to answer. First, if you're in a profession like a CPA, doctor, lawyer, or architect, you may not be allowed to operate as an LLC in California. Instead, you'll need to use a professional corporation or possibly a limited liability partnership, depending on your board's rules. Second, think about how you're funding the business. If you're borrowing money and looking to take business losses in early years, an LLC might be a better option than a C corporation. Third, are you going solo or bringing in co-owners? That might change everything from governance to pro rata ownership. Furthermore, there are liability considerations. Fourth, if you plan to have employees, there may be additional compliance layers depending on your structure. And finally, think long term. If you're building something that might grow, sell, or take on investors later, it's usually smarter to start with a legal entity from day one. That way you avoid changing your EIN, reassigning contracts, or changing over your banking later. When does a business start? Now let's clear up a big misconception. Filing an LLC isn't the same as starting a business. The IRS looks for real business activity, actually offering services, marketing, signing clients. Until then, you're not in business, you're just preparing. And no, that doesn't unlock write-offs. According to the IRS, a business officially starts when you've completed all the necessary preparations and you're ready to accept income and perform for customers. This means you move beyond the research and planning stage and you're open for business, even if you haven't made your first sale. It's not about having a logo or a domain or even a bank account. It's about being operational and engaged in a profit motive. That's when deductions begin to count. That being said, you still want to keep good accounting records for all the expenditures incurred during the startup phase prior to operations, because you can deduct them later as startup costs or organizational expenditures. Startup costs. Startup costs include all those expenses before your first sale, like marketing, consulting, and even travel. You can deduct up to $5,000 in the year you start business, but that gets phased out if your startup costs go over $50K. Anything beyond that gets amortized, which means spread out over 15 years. But as stated previously, you can't deduct them until the business actually starts. Organizational costs. Organizational costs are different than startup costs. These are tied to you legally forming your business, like filing fees, initial legal work, or accounting help. Like startup costs, you can deduct up to $5,000 and amortize the rest. But again, only after your business has actually started. What if the business fails? If your business never launches, there's still hope. Some startup costs might be deductible as capital losses if you're an individual, or as business losses if you're a corporation, but only if you have a clear profit motive and we're pursuing a real business. That's how you avoid the IRS labeling it as a hobby. Final takeaways and next steps. So here's the takeaway. Track everything. Make sure your business truly starts not just on paper, but in action. Don't take advice from someone who thinks opening an LLC is the same as running a business. If you're serious about building something real, talk to a CPA before you launch. That's how you start smart. Thanks for watching. If you're about to start or acquire a business, or even if you're in that messy in-between phase, we'd love to talk. You can find us at www.tnvllp.com/tax-planning. Until next time, take care.